Every once in a while, a signal flashes in the financial markets that's just too big, too specific to ignore. It's a move by what they call the smart money that tells a much, much bigger story. Well, today, we're cracking one of those signals open, a mysterious multi-million-dollar bet that the U.S. housing market is about to get very interesting.
Okay, so let's get right into it. The whole mystery is this. At the beginning of 2026, some unknown trader, or maybe a whole group of them, placed this huge, really sophisticated bet that home construction stocks were going to soar by the middle of the year. So the question is, why? What did they know that the rest of us didn't? What gave them the confidence to risk millions on such a specific outcome? It's time to follow the money.
And here are the details of the trade. The bet was made with 1,200 options contracts, which are really just high-stakes wagers on a stock's future price. And they didn't bet on a single company, they bet on an ETF called ITB. Think of an ETF as a whole basket of stocks that tracks an entire industry, in this case, home construction. And get this, the deadline for the bet to pay off is June 18, 2026. This isn't just a hunch, it's a surgical strike. That's a high-conviction trade pointing to a very specific window of time.
So, to really decode what this trader is thinking, we first have to understand what exactly they're betting on. And that vehicle, the ITB ETF, well, that's the key to the whole thing. So yeah, ITB is basically a basket of stocks. Instead of trying to pick one single winning home builder, this trader is betting on the whole sector. This fund has everyone, from the companies that are pouring the concrete and putting up the frames, to the retailers selling you the lumber and paint. It's a really broad bet on the health of the entire U.S. housing ecosystem.
Now, what's fascinating here is how concentrated this fund is. I mean, yeah, it holds stock in 47 different companies, but it is heavily weighted toward the giants. D.R. Horton, Lenner, and Polta Group make up a massive slice of this pie. So, let's be real. A bet on ITB is a bet on these industry titans. Their performance is what's really going to move the needle.
And if you look at the numbers, these big players are in surprisingly great shape. You've got D.R. Horton, the volume king, they're just masters of efficiency. Then there's Lenner, who's playing it smart by selling off land instead of holding all that risk. And NVR, they're a financial powerhouse with this wild model where they don't even own the land they build on. They're all different, but they're all built to win. This is the solid foundation our mystery trader is betting on.
But look, strong companies alone do not explain a multi-million-dollar bet with a 6-month fuse. For that, you need a catalyst. You need a major event. And that, my friends, brings us to the smoking gun, a massive, and I mean massive, intervention by the federal government. $200 billion. Just let that number sink in for a second. This isn't some small program or a minor tweak. This is a colossal amount of money being aimed right at the heart of the housing market.
So, where is all this cash going? Well, on January 8th, the government basically ordered Fannie Mae and Freddie Mac, the two giants that backstop the entire mortgage market, to start buying up mortgage debt. And the goal was explicit: force mortgage rates down for everyday people trying to buy a home.
And it's really important to get this. This is not the same old quantitative easing we've seen from the Federal Reserve before. Think of it this way. Fed QE is like opening the floodgates to raise the water level everywhere. This is different. This is Fannie and Freddie using their own cash reserves. It's more like a high-pressure fire hose aimed at one very specific target: your mortgage rate.
And this chart shows you the exact problem they're trying to fix. For months, the gap, or the spread, between a 10-year Treasury bond and a 30-year mortgage got weird. It was historically wide. This $200 billion injection is designed to slam that spread back down to normal, making mortgages cheaper even if other interest rates don't change at all.
Okay, so we have the players. We have the catalyst. The smart money saw the government getting ready to fire a $200 billion cannon at mortgage rates. So the next question is, how did they structure their bet to take full advantage? Because the design of this trade is just as clever as the reason behind it.
The strategy is called a risk reversal, and honestly, it's brilliant. Think about it like this. In step 1, the trader sells insurance to all the people who are terrified the market is going to crash. They collect cash from that fear. Then, in step 2, they immediately use that exact same cash to make a supercharged bet that the market is going to rally. They are literally funding their optimism with other people's pessimism.
And this quote from the source material just nails it. In the markets, fear is expensive. Bets on a crash, those are called puts, they often cost more than bets on a rally. Our trader here is harvesting that fear premium. They're turning all that market anxiety into rocket fuel for their own trade. It's an absolute pro move.
So what this all comes down to is one powerful belief. The trader isn't just hoping for a rally. They're convinced that the government's $200 billion plan has created a solid floor under the housing market. They believe a big crash is now so unlikely that selling that crash insurance is basically free money, money they can then use to bet big on the upside.
So let's zoom out for a minute, because this one trade is a signal about something way bigger. This alignment of smart money and government policy, it has huge implications for the future of the entire U.S. housing market.
One of the biggest problems holding the market back has been this lock-in effect. Millions of homeowners sitting on these amazing, ultra-low 3% mortgage rates, totally unwilling to move and take on a new 6% or 7% rate. Well, this trade signals a belief that this is finally starting to change. For anyone who's felt stuck, this could mean more houses finally hitting the market. A whole decade of pent-up demand could be about to get unleashed.
And the government is pushing this along with the classic carrots and sticks approach. That $200 billion injection, that's the giant carrot, a huge incentive for builders. But at the same time, they're waving some pretty big sticks, like threatening to ban Wall Street firms from buying up single-family homes or limiting stock buybacks if builders don't build more affordable houses. The message is crystal clear. Build more homes for people, or else.
And another potential carrot is this wild idea of a 50-year mortgage. Now, I know, it sounds crazy because you pay way more interest over the long haul, but just look at the numbers. It lowers the monthly payment on a typical loan by over $300. For the government and for home builders, the number one goal is getting more people into homes, and this policy is all about that monthly payment.
So here's how this whole story is playing out. First, the government announces the plan in early January. Boom. Just weeks later, mortgage rates hit a 3-year low. Next up, all eyes are on June 18th. That's when our trader's bet expires. But the real verdict will come after that, when we see the results from the all-important spring selling season. You can see how all these pieces are connected.
So when you boil it all down, what's the big takeaway here? This mysterious trade isn't just a simple gamble that home prices are going up. No, it's a deeply informed bet that the entire structure of the housing market is shifting, with the government and the country's biggest builders now pushing in the exact same direction. For anyone trying to buy or sell a house, this signals that a major change is coming. Which leaves us with the final and most important question. With the full force of the federal government and the conviction of some of the market's sharpest players all pointing in the same direction, are we finally seeing the housing affordability crisis start to turn a corner? Or are we just trading one set of problems for another and entering a brand new, unpredictable chapter for housing in America?